Okay, so we've covered quite a number of topics. So for this module, you are supposed to cover only up to chapter number 7. So for this module, we are left with, I think, the chapter 7. So we are left with chapter 7 to tanga with our questions. For financial accounting, you master more through doing a lot of practice, a lot of questions. It's not a theoretical subject where you need to have a lot of notes, but you need to do a lot of questions. So let's now get busy. So today we want to look at statement of comprehensive income and the statement of financial position. That's preparation of basic financial statements. Today we are going to look at the preparation of basic financial statements. So on the basic financial statements, we have the income statement and we have the statement of financial position. So let's go to our Excel. So preparation of basic financial statements. So if we are trading at the end of the period, we need to determine whether we've made a profit or we've made a loss. And at the same time, we need to know at the end of the period, how much of the assets do we have? And also, how much of the liabilities do we have? So if we are preparing basic financial statements, which are these? Is the income statement. So we have what we call the income statement, or used to be called the profit and loss. What is this for? The income statement or the profit and loss? This is used to determine whether we have made a profit or not. So we have been operating. So from operating, did we make a profit or did we make a loss? That is the income statement. So it is used to determine from the period of operation, did we make a profit or did we make a loss? So the income statement or the profit and loss, this is used to determine whether the company made a profit or a loss from operations. So the profit and loss or the income statement is used to determine whether we have made a profit or we have made a loss. So as we operate, we are going to be buying, we are going to be selling. We need to determine at the end of the period, are we making profits? So we prepare the income statement to determine whether we've made a profit or a loss from trade. Then besides the income statement, we have the statement of financial position. So the statement of financial position, also known as the statement of financial position, the balance sheet, the statement of financial position, or the balance sheet. This is used to give us a summary. We want to know at the end of the period, how many assets do we have? Consequently, how many liabilities do we have? So at the end of the period, if we want to know how many assets or liabilities do we have, we use the statement of financial position. It gives us a summary of the assets and the liabilities of the business. Provides a summary of the assets and liabilities of the business. So the statement of financial position, it provides a summary of the assets and the liabilities of the business. So it tells us at the end of the period, how much of the assets do we have and how much of the liabilities do we have? Okay, then let's move on. So let's start with the income statement, preparation of the income statement, which we can call the statement of profit and loss. Preparation of the income statement, which is the profit and loss. Preparation of the income statement. So the income statement or the profit and loss, the income statement or the profit and loss starts with the sales. So the income statement or the profit and loss, it starts with the sales. If we are looking at the sales, these are the goods we have sold from our normal day-to-day activities. So Chatsumatima sales, it's not necessarily anything we have sold, but what we have sold from our daily activities. If we are in the business that's selling grocery, if we sell a motor vehicle, it's not part of sales. So if we want to calculate the profit, we say the sales from the day-to-day activities of the business. From the sales, we then less anything that you sell, then it is returned back. We call them sales returns. So if I ask you, how much did you sell today? If you had sold 100 units and 10 units were returned, you don't say I've sold 100. You say I've sold 90 because part of the sales were returned. So from the sales, we deduct the sales returns. So from the sales, we deduct the sales returns. So from the sales, we deduct the sales returns. Just a moment. Okay, let's move on. So the sales returns, if you're looking at the sales returns, these are the goods we sold, but the customers were not happy. They decided to return them back to us. So we remove the sales returns. Then after deducting the sales returns, what we get are the net sales or turnover. So we call this figure the net sales or the turnover. So this represents what you got from sales. So to determine the profit, you say what you got from sales less the costs you incur. So what you got from the sales less the costs that you incurred. So we then less the cost of sales. The cost of sales, these are the costs you have incurred to buy the items you have sold. So the cost of sales, it could be you are producing to sell or you are buying and selling. In the case that you are producing to sell, the cost of sales is the cost of production. Kana uchigadzira and selling, the cost of sales consists of the cost of producing. But if you're buying and selling, the cost of sales consists of the cost of buying. It could be the cost, the procurement cost plus carriage cost. So cost of sales. For us to be able to sell, what costs have we incurred? So the cost of sales, you start with the cost of the goods you bought last year and you didn't sell them, which we call the opening inventory or opening stock. So we start with the opening inventory or stock. So we start with our opening inventory or opening stock. So we start with the opening inventory or the opening stock. These are the goods you started with, you have from the last period. So you bought them last period, but you did not manage to sell them. So that's our opening inventory. From the opening inventory, we then add the purchases. So from the opening inventory, we add the purchases. From the opening inventory, we add up the purchases. So the purchases, we are looking at the goods that you bought during that period. So the opening stock, these are the goods you started with. We bought them last year. The purchases, these are the goods you bought during this period. And if you returned any of the goods, you can record the net purchases. So you can say the purchases less any purchases returns, or you can subtract the purchases returns. So you can say the purchases, these are the goods that you bought. But if there are any returns, or rather, let's put the purchases in the first, this column. So we say the purchases, let's put the purchases in that column. Just a moment. So the purchases, let's put them in this column. Then when you buy something, you might be charged carriage cost. So the carriage cost, they actually increase the cost of purchases. If you are asked, how much did you buy this? You don't just talk about the purchase price, but you also include the cost of carriage. So besides the purchases, we also have the carriage cost. If there are any carriage inwards costs, carriage inwards is the cost of bringing the goods in the business. So we add the carriage inwards cost. So you say the purchases, you add the carriage inwards. Then you you deduct if there are any purchases returned. So the purchases returns, we are deducting them. These are the purchases. What I'm putting in bracket, it means we are deducting. We subtract the purchases returns. These are the goods you bought, but you returned them to suppliers. So you're saying what the goods you bought plus the carriage less the returns. Then you get your net amount, you put it that side. So you put your net amount in this column. So what were we calculating here is the cost of the goods we bought. So we said the cost of the goods we had last year that we did not, or the cost of the goods we brought from last year is the opening stock. The cost of the goods we bought this year, the purchases, plus the cost of carrying them, the carriage. Then we deduct the goods we returned. We add up what we had plus what we bought. We get a total. Then we less the goods that we bought this year. but we did not, sorry, we less the goods we did not sell this year. We less closing stock. Because remember, we want to calculate the profit from the goods we sold. So we less the goods we have not sold. So the closing stock or closing inventory. So you deduct the closing stock or the closing inventory. You deduct the closing stock or closing inventory. What you get here, this figure here is called the cost of sales. That is the cost of sales figure. So everything we were doing, we were calculating this figure, the cost of sales, which is the cost of the goods we have sold. So we start with the cost the goods we had at the start of the period. We add the goods we acquired during that period. You less the cost of the goods, you less the cost of the goods that we did not sell this year, the closing stock. So this figure I'm highlighting here, it represents the cost of buying and transporting the goods we sold. So if you say the sales less the cost of buying and transporting the goods, we then get what is called the gross profit. So if we say the selling price less the cost of buying the goods and transporting them, what we get is called the gross profit. We do that, we get what is called the gross profit. So the gross profit is the profit before deducting expenses. The gross profit is the profit of the business before deducting expenses. The gross profit, it is the profit before deducting expenses. So far we've only accounted for the cost of buying the inventory. So if we are talking about the gross profit, this is the profit after we've only considered the cost of buying or producing what we have sold. But that is not the only cost. They are in business, you need to hire, in some cases, you need to pay employees. You might need to pay for rentals. So those are called expenses. So the gross profit is before expenses. If we remove expenses from that gross profit, we then get what is called the net profit. So from the gross profit, you add other incomes. Before removing expenses, you add other incomes. Which are the other incomes? The other incomes we are looking at, the other incomes, other activities which can bring income to the business, but which is not the core business of the company. For example, you can be running maybe let's say a clothing shop, and so you're running a clothing shop, but you can find someone then they want to rent a space in your shop doing eco-cash, and they pay you rent. So when they are paying you rent, it's income you are receiving, but those are not your sales because your sales are from selling clothes. So the rent you are receiving is not classified as sales, but we put it under other incomes. So this comprises of things such as rent received, discount received, commission received. So the other incomes, these are the received. You also put, but this one, we'll deal with it maybe when you're now doing the FIN 1B. We also have decrease in provision. Decrease in provision, it's just take it down on the format. Decrease in provision for bad debts. decrease in provision for burdens. The decrease in provision. So these are the other incomes. These are what can bring money to the organization, but it's not your core business. The other incomes, they can bring money, but they are not the core business. So the other incomes, add up the other incomes, add up the other incomes there. After the other incomes, we then less expenses. So after the other incomes, we then less the expenses. So after the other incomes, we less expenses. So the expenses, these are payments we make so that we can operate. They are normally done regularly. So every month we pay for this. It could be we pay for rent. It could be we pay salaries and wages. Vashandi vachanga operator. Could be we pay for insurance. So the expenses, these are regular payments. The list of expenses for a business is very long. It depends on the type of the business. I'll just list down some, but not all of them. I'll just list down some of the key expenses. But I can't list all of them because agawanda depends on business ratio. So I'll list some of the key expenses. I'll list some of the key expenses. Okay, so for the expenses, so on the list of expenses, you can start with the general expenses. I'll just summarize some of them. The general expenses. We can have selling and distribution expenses. So it depends on what they've given you on the question. We can have carriage outwards. I'll just list some that might confuse others. Carriage outwards is an expense. We can also have depreciation is an expense. Depreciation is an expense. Carriage outwards is an expense. Depreciation is an expense. Depreciation is an expense. Another expense, so carriage outwards is an expense. Depreciation is an expense. We also have increase in provision. So the expenses are a lot. We have rent and rates, salaries and wages. We have insurance. We have we can have motor expenses. So it depends on the question. So I've just given you a few. So the expenses, their nature is mainly you pay for them on a monthly basis or regular basis. So you list down all the expenses that we are incurring. Then after listing down the expenses, then you get your net or operating profit. So this one is the operating profit. So the layout that I've given you, this is the income statement of a sole trader. This is in the case of a sole trader. So this is the income statement for a sole trader, which is what you are likely to be asked. So you need to know for now up to the operating profit. So this is the operating profit. What if this was a company? So if it was a company, so a sole trader up to here, so for a sole trader, sorry, for a company, we remove from the operating profit, we remove finance cost. So if the company received loan and they are paying for any, if they received a loan and they are paying any interest, the interest on that loan is a finance cost. It is deducted from the operating profit. It is deducted from the operating profit. Then they are likely also going to give you taxation. So taxation, you then deduct tax. Tax is deducted from the profit, but you deduct it after all the other expenses. So you get your profit after tax. So if the question is for a company, they are likely to give you taxation. So this is the profit after tax. So this is the profit after tax. So the profit you have made in the business, remember, you're saying what you received less the payments you made. So the payments you make, you pay for cost of sales and you pay for expenses. So you're lessing from what you received, you deduct from what you received, you deduct the cost of sales and you deduct expenses. Now let's look at the statement of financial position, which is the balance sheet. If you are required to prepare the statement of financial position. The statement of financial position or the balance sheet, it is based on the accounting equation. So we want to trace the assets and liabilities that we have. It is based on the accounting equation. So the statement of financial position is based on the accounting equation. It is based on the accounting equation. So what does the accounting equation say? So the accounting equation says that equity or capital is equals to assets minus liabilities. The capital of the business comprises of the assets and the liabilities. The capital is equals to the assets minus liabilities. The capital is equals to assets minus liabilities. The capital is equals to assets minus liabilities. So if we are preparing the balance, if we are to rearrange this, in fact, this is the same, or if we say capital, let's take liabilities the other side. Capital plus liability should be equal to our assets. So that's what we want to just prove. If we are preparing the statement of financial position, we just want to prove that if we take the capital and we add it to the liabilities, we'll get assets. So we want to prove that if we take the capital and add it with liabilities, you get the assets. you take the capital and you add it, capital plus liabilities, you get the assets. Okay, so if we are talking about the capital of the business, this is what we have invested. The capital can be money or it could be shares. So capital, it could be money or it could be shares. So for a company, the capital consists of shares. Then the balance sheet, like I said, is there to prove that the capital plus liabilities is equals to assets. So if you want to prove that, you start with the assets. So you say you add all the assets and you add all the liabilities and capital. These are supposed to balance. Tkatora, the assets, total liabilities and capital, if we add them up, they should balance. Okay, so we are saying the assets, we start with the non-current assets. So if you are preparing, that's now the statement of financial position or the balance sheet layout. Statement of financial position layout. So for the layout of the statement of financial position, for the layout of the statement of financial position, who is that with their mics on? Me mute. Okay, so if we are preparing the statement of financial position, we start with the assets, the non-current assets. We start with the non-current assets. The non-current assets, these are the assets that stay in the business for a long period of time. So these are the assets that we can have for years, more than a year. Which are the non-current assets? We can have the buildings. We're going to have the buildings. So we are going to have also the cost. We have depreciation. We call it accumulated ACCDPN, accumulated depreciation. Then we have the carrying amount. So for the balance sheet, we are going to have the cost, accumulated depreciation, and the carrying amount, or some can say the net book value. So the buildings, we put the cost here, we put the depreciation here, and the carrying amount. So when we are now doing the questions or the examples, I'll be explaining how you derive these accumulated depreciation figures. So the buildings, we're going to have the machinery. The machinery used, we're going to have things such as the furniture, the vehicles. These depend with the question. These are some. These are some of the non-current assets which are common. So the accumulated depreciation is being subtracted. So you say the cost minus the accumulated depreciation, you get the carrying amount. Then after that, those totals, but the only important total is the last total for the carrying amount. The only important total is the last one. These two You can even close them. So we are going to move with the last column, that one. So we've added the non-current assets. The assets of the business should be equal to capital plus liabilities. But the assets are not just non-current. We have non-current and we have current assets. So besides the non-current, we also have the current assets. Which are the assets that do not stay in the business for a long time. So we have the current assets. These are the assets that do not stay in the business for a long time. So for the current assets, which ones do we have? So for the current assets, we can have inventory. Current assets, we have inventory. You can list the current assets on the second column. We have inventory. For the current assets, we have receivables. Receivables, these are the customers that are owing us. So it's an asset to you. Money you're expecting to receive, it's an asset to you. The receivables, they're an asset. The receivables are an asset. Besides the receivables, we also have cash at bank and cash in hand. So another asset is the cash at bank. And besides the cash at bank, we have cash in hand. Cash at bank, and we have the cash in hand. So all these are assets. And also if we have prepayments, if there are any expenses prepaid, means we paid expenses in advance. So paying an expense in advance gives rise to a current asset. So we add up all the current assets. Then we put the total this side. So add up all the current assets and put the total that side. Then what we get here is the total asset figure. Total assets figure. What we get is the total assets figure. The total assets figure. So now we have the assets. We are done with the first side, the assets. We have said if the balance sheet is balanced, or in the balance sheet, we need to prove that the assets are equal to capital plus liabilities. Now we then say financed by. We then say financed by. So financed by, we start with the capital. So financed by, we start with the capital. So financed by, we start with the capital at the start of the period. So this is the opening capital. So financed by, we have the opening capital. Then we add net profit. So the opening capital, we add the net profit. The net profit is what we have obtained here. So the profit that we make increases our capital. If you start business today, the more you make profit, it's actually increasing the capital you have. Losses, on the other hand, reduce the capital. So we are saying The profit, we add it to capital. So now we're done with the capital. So no, the profit increases capital and the drawings reduce capital. So we less drawings. Profit increase capital, but drawings reduce capital. When you take goods for personal use, it's reducing your capital. So the drawings tend to have an impact on the capital. They reduce the capital. Less drawings. So the drawings reduce the capital. Then, so we're done with the capital. This is the adjusted capital. After the capital, we add the liabilities. So we start with the non-current liabilities. These are the liabilities where we have to make a payment. We can make a payment even after a year. So non-current liabilities. You can have the loans and debentures. The loans and debentures. Okay, besides the loans and debentures, let's move to current liabilities. So after the non-current liabilities, we move to current liabilities. The current liabilities. So for the current liabilities, these are the payments we have to make before the year end. We can make payments for trade payables. So the current liabilities, we have the trade payables, we have accruals. We can have bank overdraft, taking more than what you have in the bank. So these are some of the current liabilities. You have to make payment before the year end. So you can sum up the current liabilities. So we then add up, or you're adding this, take note that one, you add the figure for non-current liability, you add the figure for the current. So the figure you are going to get here is the balancing figure. So this figure here should be the same with, if you have done everything correct, should be the same with this one. Those two should be the same. If we have done the correct thing, those two should be the same. So that's the layout of the income statement. Now, what we are going to do is we need now to use figures to demonstrate that. We need to use figures to demonstrate that. But today, since you have a tutorial at 1, since we have a tutorial at 1, I think we'll do in figures in the next lesson. So that because we want to do law and I give you time so that you can join the result tutorial. So this is the layout of the income statement and the statement of financial position. The income statement and the statement of financial position. So these are crucial for any business. The income statement and the statement of financial position, these are the final accounts. They tell us how the business has been operating. Have we been making a profit and have we been making a loss? So for your module, you will realize